let's see if Renaud Laplanche, who is the CEO of Lending Club, and David Kirkpatrick can have the same energy level. Renaud created Lending Club in San Francisco. He's French, and I think he doesn't have enough coverage. It's amazing what he does, and David will help him tell the story. Renaud and David, please join me on stage.
I would be afraid if I yelled that loud, I'd break the PA system or something. But everybody's style is different. So great to be back on stage. And this is something a little different than the Microsoft and Facebook things I've done up to now. Renaud Laplanche started Lending Club in 2007. It's not a company most of you know as much about as you need to. And I suspect after you hear his remarks, you're going to realize this is a pretty amazing story that is not getting the attention that, for some, we'll talk about why you haven't made us all aware of it too much earlier, but why don't you just quickly describe what Lending Club is, and then we'll kind of delve into where it's going.
Great. So Lending Club is a platform that originates consumer loans online in the US to prime consumers, so to the top 10 to 20% of US consumers by credit quality and by income. And what's really unique about it is we let investors invest in the loans directly at the time of origination. So a traditional bank would collect deposits from depositors and turn around and make loans to borrowers. What we've really done is we've collapsed the value chain into one single transaction where investors fund the loans directly at the time of origination. And doing so really helps save on cost. And the cost savings get passed on to borrowers in the form of lower interest rates.
Okay, if you're going to say that now, we should look at the first slide. Can we have the first slide? Now, I'm going to press this button hoping that the slide will show up. Anyway, maybe it'll come in a minute. Can we get that first slide? There. Oh, no, that's not the first one. Hold on. Those are good slides, too. Oh, but how do we get it? I'm just got a green and a red button, so I can't control that, I don't think. Well, can you see that slide there? Okay, is that good enough? I don't know. We only have, like, the desktop image there. Okay. Anyway, what his slide is going to show is why it's cheaper. Okay, to just quickly explain. So this is the sort of visual illustration of what you were just saying. Just quickly say what we're looking at here. You know, the traditional bank costs more to operate. That's what this shows.
That's right, and that's really the proof point of what I was saying earlier, which is a traditional bank would really rely on a lot of physical infrastructure, thousands of branches, hundreds of thousands of employees to collect deposits, to have a branch in every corner, and then to make loans to consumers. Lending Club operates fully online, and by doing so, we really save on the cost. And the proof point is a traditional bank would spend 5 to 7% of outstanding balances to just power these deposit-taking activities. In the case of Lending Club, the same ratio, the same metric reads about 2%, and it gets even better each quarter as we gain scale. So it really scales more as a technology company rather than as a bank.
Okay, so since you're talking about scaling, let's go to that other slide. This is how it's scaling. That's total loans given. What you do, I thought you had the thing with the 500 million. Oh, is that on the other slide? He only hit $500 million in total loans in February of this year, and he's already at $1 billion. So in the last 8 or 9 months, he's added $500 million, and they're currently on $1 billion a year run rate. Can I just say this? But you expect in the next 12 months to do $1.5 billion. This is an incredibly fast-growing, disruptive business, which I like actually doing this on stage at LeWeb, having done Facebook and Microsoft, which are more pure technology companies. You know, you are a great example of what I mean, I have a company called Techonomy, which is all about technology disrupting and amplifying and changing everything in business and society, and you are a great example of what's possible. And if just talk a little bit about Prosper, because that's your competitor, right? I mean, Prosper is probably a business more of these people have heard about, and yet it started 2 years before Lending Club. And how do the two companies, compare today?
Mm-hmm. Yeah, so there were about half a dozen startups that started similar businesses.
Half a dozen, wow.
Right, at the same time, around 2005, 2006, and 2007. And we've emerged as a leader. And really what you see here is marketplace dynamics, where the larger marketplace becomes increasingly attractive as it gets larger, and really size is a factor of success.
So you almost have network effects.
That's right.
In banking. Why is that exactly?
Well, the platform really operates as a marketplace. So you have borrowers on one side, investors on the other side. And for investors coming in, the larger the marketplace, the more choice, the more inventory you have. You have more borrowers you can choose from. From the borrower side, the more investors you get, the more liquidity there is, and the faster your loan gets funded. So it's really a little bit of an eBay story, but applied to banking.
So it's really an eBay of banking. That's interesting. So the more borrowers, the more investors, the more investors, the more borrowers. You have 7 times the size of a business now of Prosper. So it's 7x larger than Prosper today, which is pretty amazing. And so you're winning that race, which means you're kind of in the position to really disrupt consumer lending in the United States, at least. So let's just finish the slides again. There's a more detailed one. Oh, there was another red line there. I didn't know. Okay, there's the red line, but we were looking at the last few months. That's just the last few months. Loan originations by month. So you said last month you did 87 million. And you're getting a little more transparent with your numbers right now, right? Because you're sort of thinking maybe you'll go to an IPO sometime soon. Is that right?
Mm-hmm. We might. But we've always been very transparent. So that's really one way we've earned confidence from investors. It's by putting as much data as possible out there while respecting the privacy of the borrowers. But for example, all the loans that we've ever made are available online for investors to see on the performance of the loans.
By the individual loan, if they want to look at
individual loans, so it's stripped out of any nominative information, but you can look at the performance of every single loan we made since 2007. That's transparency.
And what is the default rate?
So default rates has varied over time. It started low. It went up in 08, 09 as the unemployment rate went up in the US, and then came back down in 2010 and 2011. Now it's about 3% a year. And what's really important for investors is to diversify their investments. So if you lend money to one person, it's a very risky investment. There's a binary outcome. The person will reimburse you or not. If you spread your investment into 1,000 different borrowers, and you have more chances to hit that average 3% default rate. And the way the math works for the investors really is you invest at about 14%, you get 3% default rate, and minus the fees, you end up at 9 to 10% net return after default and after fees.
Wait, so the net return is how much?
9 to 10%.
Oh, I think you said 8 to 9 on the phone yesterday. You just went up a point. But okay, but that's pretty good. So what other investment can investors get 9 or 10% on right now, like zero? Reliable returns at that level are unheard of right now. And what is the typical interest rate for the borrower?
So the borrower interest rate is around 14%.
14?
Right. And what's really important to realize maybe for the audience is the interest rates in the US or the base interest rates are very low, like everywhere in the world. All the central banks have kept interest rates near or at zero. But the rates, the lending rates on credit cards tends to be between 16 and 18%. And that's really what we're competing against. So the loans made by Lending Club are really an alternative to credit cards. There's $850 billion in credit cards outstanding in the US. And most of these balances carry interest at 16 to 19%. So our ability to deliver a 14% rate to borrowers really helps borrowers save on cost.
Well, you're also getting to sort of what inspired you to do this in the first place, because you're a lawyer, you're not even a banker. So just quickly, why did you want to get into this business?
Right. So the idea of Lending Club really came to me the first time I paid attention to a credit card statement and found out that if I were to carry over the balance to the next month, I would be paying 18% interest rate on that balance. And really the thought that came to me was, okay, why is it that if I put my money at the bank, I'm going to earn 1% interest on that money, if that? But if I borrow what seems to be the same money from the bank, I'm going to pay 18% on that balance. And that seemed like a very big spread. And when you're an entrepreneur and you see a big spread, you immediately think big disintermediation opportunity, especially when the spread is really due in large part to infrastructure costs, legacy systems that can really be replaced with technology and an online platform and new and more efficient processes.
Yeah, going back to that. Oh, well, green button didn't work. We just get the, yeah, whatever. Just want to illustrate that again. So how big could this get?
So that's the exciting part. It can get quite big and be quite useful to a lot of people. The US credit industry is one of the largest industries and one of the largest markets in the world. So credit card receivables in the US is about $850 billion. If you add student loans and auto loans, that we'll do at some point, you get to $2.7 trillion. And when you add mortgages, you get to $15 trillion. So
and
it's a big
you
industry.
think you could get into mortgages with a similar model?
Mm-hmm. Yes.
So you have a business that you think you could really scale to be like Citibank scale or bigger? I mean, come on, that's big disintermediation, if I might say. But this is the kind of business that I particularly like, and which I think business leaders in other industries typically underappreciate, to speak mildly, and basically they're basically sticking their head in the sand in so many industries that you saw that spread, and you basically have created a business that is growing this quickly and has that kind of upward potential. I love that, although I just wish that more of our business leaders would recognize that it's possible, because they're all just sort of doing things the old way. And in your industry, it's probably the ultimate example where they're getting these massive compensation. I mean, a lot of the difference between your 2% and the 7% is all the stuff that the Occupy Wall Street movement was protesting, right? Right. So that is really interesting. I wanted you to talk also a little bit about, I mean, the difference between you and Prosper is interesting to me, and I'm not trying to criticize that company at all, but when I think of them as being about sort of democratization of lending and making loans available to people who might not otherwise get access to them, but that has not been your approach, right?
That's right. So when we started, there was really a choice of positioning. We could have gone for sort of making credit more available to people and sort of offer credit to folks who can't get a loan from the bank. That's obviously a riskier proposition. What we focused on is really building up on our cost advantage to deliver a lower cost of credit for the most responsible borrowers who already have banking relationships, they already have a credit card. And in fact, the main use case for a Lending Club loan is to pay off an existing credit card. And that's how we market the program to borrowers. We go to consumers who have good credit, stable employment, who recently used their credit cards and are paying down the balance over time. And we're telling them, hey, you have good credit, you shouldn't be paying 18% interest rate on a credit card. Why don't you refinance with a Lending Club loan? So we've always focused on that top 10 to 20% of the market.
Now, to me, who has good credit, 14% still sounds high. I mean, can you get it lower for extremely good risk clients?
Yeah, you can. So we've implemented a lot of risk-based pricing. So there's a risk ranking algorithm, and if your credit is perfect, you can go as low as 7%.
Oh, I see. But in a sense, it's not so much a business oriented towards consumer empowerment as it is to bringing efficiency to a market that is just radically inefficient by your obviously provable analysis. So why haven't we heard as much of, I mean, obviously the consumers are hearing about it because they're coming to you and borrowing from you, but in the industry, in this sort of inside baseball, digerati, internet, bubble, endless verbiage community, we haven't really heard much about Lending Club. Have you tried to keep a low profile until recently, or what?
Yeah, I think we're starting now to prove the model. We're starting to have enough of a track record to really come out and show the results. In consumer credit, it's not the kind of business that you can grow very fast immediately. You really need to earn the confidence of the consumers. We're dealing with people's money. It's a serious business. So there needs to be a lot of controls in place, and you need to grow slowly initially, gather the data, gather the track record, build out the regulatory framework, build out the IT security, all the things that you need to run the equivalent of a bank.
Right.
And now I think we have everything we need to say, okay, it's working, let's do more of it. And that explains the acceleration over the last few months and the growing interest from the press.
I just want to have that slide with all the little lines on it again, if we can, because you've clearly, crossed the chasm, so to speak, at some point recently. Can we get that slide, which was originally the first slide? No, not that one. That's another person's presentation. But anyway, I guess, okay, I'm not Mr. Slide here. But the point is, you went through very seemingly slow growth for quite a long time, and now you have just really pushed the arrow up. And that, you're saying, was a matter of just putting a lot of things in place and proving yourself to a lot of different communities. One of the things that I also found interesting that you were saying, and it ties into this high return that you're able to bring to people, is that you've been getting large investments from large institutional money sources like insurance companies, pension funds, and how much are some of them putting in at a time now to your business?
Yeah, that's really part of the same aspect of really starting slowly, building up the track record, trying different credit policy, different underwriting strategies, and once it's really working, stepping up on the gas pedal. And so what we've seen over the last year, since we really started marketing the program more aggressively, we've seen larger professional, institutional investors gaining a lot of confidence in the program, and now being able to look at 5 years of track record showing net returns that are far above what they're earning in the bond market or in any other fixed income strategies. So we've been able to prove that and really gain the confidence of large institutional investors like insurance companies, like pension funds that are now investing $50 to $100 million on the platform.
Some of them are giving you $100 million at a shot, yeah. And one of the other things you said that's interesting is you're like the only non-banker in your management team, right? I mean, you're the entrepreneur, but it's an interesting case of a guy disrupting a business with an idea, but then he brings in veterans. So just quickly, who are some of the people that you're working with? What kind of people are they?
We were talking about risk and credit quality. For example, our chief credit officer is Xiaomei Chen. She was the chief credit officer at JP Morgan Chase Card Services, which is the
biggest card issuer, yes.
Largest issuer of credit cards in the world. It's a $160 billion portfolio. Our CFO was a CFO at Schwab Bank and the corporate treasurer at Schwab. So we have a lot of executives coming from the banking industry. I think myself and our chief marketing officer are the only one.
So you have one other
industry.
person.
Right. And the point is, we really did not want to sound or look like a bank. And so the entire marketing team does not come from the banking sector.
That's interesting. So you're going to try to avoid looking like a bank, which in our limited remaining time, in terms of where this goes, you really don't want to sell to a bank, even though probably a lot of them are increasingly going to want to buy you. Is that right?
Right. The banks are watching, and they're finding what we're doing very attractive because, again, we can do the same thing at a much lower cost. But I think what we're doing now is really building the company for the next 10 to 20 years. And we've barely scratched the surface of what we can do. We've only issued $1 billion in loans We're really happy about it. It's a big number, but in the context of a $2.7 trillion industry, it's really not that much. So we feel there's a lot of runway in front of us, and we want to continue doing what we're doing and be more useful to more people and continue to help our customers.
So what are you going to do in terms of, you know, maybe getting a return for yourself kind of thing?
So we are lucky that there's a lot of interest for the stock. So there's an active secondary market. Any employee who wants to sell shares have been able to do so. So there's already liquidity, even though we're a private company. That being said, we're a consumer-facing company, and there's a lot of benefits in being public in that context in terms of raising awareness for the company and continuing to build up credibility and confidence. So we're planning on going public in the next few years.
Can I say this number of months you said yesterday?
Yes.
You said within 18 months. I mean, that's not the next few years. I would say if you continue on that growth rate, you're going to have one of the most stunning IPOs, maybe the most stunning internet IPO. I could see you having an extremely successful IPO. You were just saying also that you're now profitable. You just had your first profitable quarter. You have $50 million in cash. So and that's like just at the beginning of having kind of crossed the chasm. So I think your business is going to really do super well, and we're over time. Anything that you would hope to say on stage that I didn't get to, since I sort of jumped into this interview a little bit last minute, thanks to Loic's wanting to assign me suddenly to something?
No, you did great, by the way, with little preparation time. No, I think the general idea is we are applying technology to an existing and a proven market, and I think it's also partially why you don't hear about Lending Club as much as you hear about cooler and more sort of innovative things. We're not creating necessarily a new product. We're making an existing product, a very large industry. We're making it better and more efficient. And that's another way to look at innovation and another way to look at technology, making existing products better. Well,
ultimately, it's probably the most important way in the long term because it's infecting everything. And you're really an incredible example of what's possible. So good luck, and I can't wait for the IPO. So thank you all.
Thank you.
Thanks.